want to get rich the old-fashioned, slow and steady way through investing in ETFs, that's great. It will at least, the very least, provide some sort of insurance that you'll be taken care of in your old age. Look at this, 20 to 40, 40 to 50, and after you're 50 years old. It's the whole breakdown. It's really easy to follow. But what if you want more? What if you want more growth? Well, more growth or faster growth sometimes means taking on more risk. Speculative investing is great, but it can be super, super risky because, hey, what if you pick the wrong stock? What if today you say, I think this company is going to lead the future? And it doesn't really lead the future. In fact, maybe it lags. Maybe there's mismanagement, or the company sucks, or the direction sucks, and they just fail to deliver. Whereas that other company over there that you looked at and you thought about, but you passed up on, that's the one that ended up going up. Oh, wouldn't you feel like an idiot? Fundamental analysis is super important. I'm going to show you how to do it. The very first thing you're going to do is you are going to go right here and you're going to click on the menu, which is right here. Unlike every other finance content creator on social media, I don't sell anything. Everything here is free, but what you want is the fundamental template. And this is what the template looks like. But if you go right here, there's a clickable link so you can fill it all in. If you say, hey, I don't know where to find all this stuff, scroll up and there are videos right here to walk you through how to do it. So the fundamental analysis, it's easy. You want to see that revenue is increasing, free cash flow is increasing, cash is increasing, assets are increasing. You want to see that debt is maybe also increasing if it's a new company, but not faster than the revenues and the cash. And if they pay a dividend, you want the dividend to be going up. It's all very self-explanatory. You're smart, you'll figure it out. But an equally large part of speculative investing is that you, as the investor, you've got to have some sort of vision. And maybe it's not even a vision that you can put into words. Think about Apple for an example. In the early 2000s, they came out with iTunes and then the iPod. Now, if you were paying attention, maybe you had those devices, an iPod, an iTunes account, and you thought, this is interesting. Maybe I should make a small speculative investment. You'd be very, very rich today. Now, maybe you couldn't have envisioned that they'd come out with a phone and then an iPad and then wearables like an Apple Watch, maybe a streaming service. That stuff didn't even exist back then. But you might have had the vision, or at least the understanding, that something was happening here that made it maybe worthwhile to take a small speculative investment. But as the company grew and innovated, that's when you would do something different. See, we're always taught buy low, sell high, but there's another way to go about this, which is buy high, sell higher. But you have to have a vision. And a lot of new investors or experienced investors just don't have that. You know how I know? I read the comments here on TikTok. And I say, hey, here's a company I really like. And they go, well, that company's stupid because they only do this one thing. Hey, buddy, we live in a capitalist hellscape. Every company on the planet has one goal. That is to innovate and make more things so they can sell more stuff. You think any company on the face of the planet is like, let's just sell this one thing forever and have pretty decent revenue forever? Come on. Speculative investing can be a great way to blow up your account or pick some small investments that could grow over time, allowing you to retire a little bit earlier. Smash that follow. See you later.